Well, welcome everyone. Thanks for the opportunity to debate these very important issues with this group and also with a group of panelists who've got a great deal of experience in these issues and in the markets. Debt is very important, and I think I'm going to focus here on what we're calling non-equities. I like the idea of non-equities. I've never felt that I worked for a division that was non-something. And I think therein is part of the problem. There's equities and there's non-equities. So that means that credit derivatives are the same as commodities, which is the same as a government bond, which is the same as an interest rate swap. That's patently not the case. And I think one of the key things is we need to start to get some granularity about each of the markets and the sub-markets. Even the credit market, which is the one that I'm representing and dear to my heart, that has many sub-sectors, some would say subcultures. And even the regulation between one part of the credit market and another, or one jurisdiction and another, even within Europe, is completely different. The debt market, I'm going to focus on the bond markets today. The bond market is very important, and I'll tell you why it's so important. In the US, around 10% of financing is done through the loan market, and the rest is through the bond and the securities markets. In Europe, the figure is 70%, so 70% of financing is accessed through the loan market. Now, we know what's happening to the banks' balance sheets. They're not going up, they're going down. And there's a variety of reasons, but that means less lending. That means less bank lending. And also, if you look at the levels that bank lending has been done in the last decade, it's very, very low spread levels or very low cost. So not only is the cost going to go up, but the access is going to go down. So the capital markets are crucial, the bond markets are crucial to facilitate that transference from a bank market to a capital market. And so really when we look at all these issues, we really need to understand, are the regulations going to help that process or hinder the process? And potentially what other ideas or regulations could be put in place to speed up that transference from the loan market to the bond market? And just to put some numbers on it, there was a recent S&P report which basically said that in Europe, companies need to increase their bond issuance by 50% in the next 5 years. So that's a fairly large number. A $210 to $260 billion shortfall from bank lending has to be made up in the capital markets. So they're big moves, big numbers, and they're happening at a time when it is the most febrile trading and investing environment I've been in for 27 years. So we need to look at the various things. We're talking about transparency, and I think transparency is seen as a good word. And there's bad words and there's good words, and transparency is seen as a good word. And it generally is a good word. I mean, if you're driving along and your window is completely dark in your car, you'll probably crash. But in the bond markets, it's slightly different. Transparency can be very damaging. And what we're looking to achieve is get the optimal transparency rather than total transparency. Both Eddie and Kay talked about getting quality data. So sometimes people talk about quality data is a lot better than more data. In fact, what we saw from MiFID I, and I had direct experience of this, I actually was the executive in charge of a boat which collected the OTC data. And so I saw at first hand what happened in the equity markets and what went wrong in a sense almost overnight. And suddenly buy-side clients threw their hands up and said, we can't prove best execution anymore. We can't understand the data. It's all coming in different formats. It's duplicated. There's no common standards. There's no common delivery. We can consolidate it, yes, but at an exorbitant cost of around, I think, 12 at the time, 1,200 euros a month per person, which is obviously way too high by probably a factor of 10 or 15. So it was a big problem, and I think although there's a lot of benefits on the exchange side and on dealing costs, and I think those were universally seen as a positive that opened up the market, the equal and opposite problem was the data that was created, in a sense the bad data. And we're very worried in the bond market that we don't create the same issue. When we look at pre-trade versus post-trade, we're looking at very different things. A lot of us sitting there saying, pre-trade, that's really interesting because there's so much pre-trade data out there. An institutional fund manager of medium size will receive 20, 30, 40,000 price messages a day. There's engines which sit there. Of course, you can't see that because they're scrolling through quick. their screens just turn over like this. But so you have these engines called parsing engines, and they basically turn all that raw data into an exchange for the buy side. And if you talk about asymmetry of view, the sell side has no view in this. They push the data into the machines, and the sell side sees all the information. Now, there's an argument about who receives those messages. It's not regulated. But the reality is, on the institutional market, they have huge pre-trade transparency. Post-trade is definitely more difficult. And I think a post-trade tape, it can be argued both sides. The positive arguments for it are it gives transparency, it gives confidence, it's fair, and it brings more people into the market. And I think that's a very valid argument. The counter-argument is in very illiquid markets, that price information can mean that the buy-side investor can't get his trade done in a sensible format or even at all. And in a sense, this comes onto the issue of liquidity. You read a lot about regulation, liquidity, and I think the discussion is getting lost a bit because for a lot of people, what does liquidity mean? What does the actual word mean? It means complete different things in the equity market to the bond market. In the equity market, when people talk about liquidity, they quite often associate excess liquidity with high-frequency trading, and people say, well, is there any point in that? Has it any social use? What does it do? Could it create a systematic collapse? And so the concept of extra liquidity in the equity market, a lot of people will say, well, maybe we don't need extra liquidity in the equity market. Maybe it's liquid enough. In the bond market, liquidity means you get a price or you don't get a price. And that situation is getting a lot worse. And it's even hitting the government bond markets. So it's not a case of extra trading liquidity and we don't need it. We need every single piece of liquidity we can have in the credit markets, A, because they're so free-born, and B, because they need to grow to do the financing that's being taken out of the loan market. So it's a very, very key issue. We've talked today, the speakers have talked today about calibration. I think calibration is absolutely key. We need to walk into this in steps. We don't want to, wake up. I can't remember when MiFID I was. I think it was 1st November. We woke up and the world had changed and people were scrabbling around, and that was in a very stable equity market with a lot of liquidity. So I think calibration is key, and layering in the experience, a little bit like Trace did in the States. Put some in, then have a look, examine it, put some more in. I think calibration is very key, and I think ESMA is going to have a crucial role in determining that calibration. I think that also the data issue has been referred to again, both by Eddie and Ken. I completely agree. I don't really want to reiterate everything they said because they said it so well. But the reality is that this is not an area to experiment in. And I think really, as a practitioner, and I respect the remarks of the previous speaker, but I think really there's only two choices in my mind. There's choice A is a mandated, effectively, vendor or provider that basically all the data goes into that player and all the data comes out of that player. That keeps the cost to the absolute minimum for the overall industry. It ensures one data standard, minimal leakage. They can even have some regulatory SRO type responsibilities, as does Trace. So that's from all the markets' perspectives. If we're going to go into this regime, that would be choice number one. That gives the best quality data, lowest price, and there are concerns that potentially that can lead to complacency and lack of innovation, but a frequent tender process tends to keep the vendors on their toes. The second choice, which is workable, in my opinion, not as optimal, but is workable, is where the data standards are set probably, again, by ESMA. So if there's data fields, maybe 30 data fields around a trade, they are set, there's no debate about them. If you are a collector of data, and that means a competitive field, you can compete as much as you want on price, but those fields have to be in place. So you allow pure competition on that area, but you don't have the data fragmentation. So that's sort of choice number two. Choice number three, which is the one I'm worried about, which is let the market dictate a solution, and if it doesn't work, we will come back and change it. That's better than nothing, but unfortunately what that means is the market probably won't come together in a solution, and then in 2 years' time we looked at, then studied, and we'll probably have 3-4 years of bad data in the market before it gets rectified. So I think it is a solution, but in my mind, least optimal. I think the other issue is, underlying all these, we've talking about pre-trade and post-trade, I think we have to start looking through an additional lens on all regulation. I'm straying away a little bit from MiFID and pre-trade and post-trade, but we have to look at various areas. Obviously, the overall health of the market, how deep is the market, how useful is the market for the participants. The cost, we need to look at cost. Cost is under pressure everywhere in all of the industry because of the low growth rates, and so excess costs, unneeded costs that's being heaped on an industry at the moment that's under duress is not necessarily a good thing. We also need to look at the practicality of implementation. When you look at all the regulation coming from principally both sides of the Atlantic, we have an enormous amount to adhere to as an industry at the same time. And a lot of those regulations are conflicting with each other despite the best efforts of everybody to try and get them to coordinate. But I think the most important of all is what is the effect of these regulations in isolation and cumulatively on the real economy and the growth agenda that is likely to start to get center stage in Europe in the second half of this year. Every proposal that is being considered to solve the financing issues in Europe will ultimately fail if there's no growth. So it doesn't matter if there's Eurobonds or bills or subsidies, they will be a short-term or medium-term palliative, but unless the growth starts to pick up in Europe, they will ultimately all fail. And so the key issue will be growth. It's likely to start getting more momentum in the second half of this year, and I think regulation needs to be looking at that and work out how is it helping the growth agenda on top of the other objectives that has been set out to achieve. So I'll leave it at that. Thank you.